there, everybody. This is Craig at Max Trading, and it is truly a pleasure to welcome you to our real-time trading session today. Great to have you in the room with us. And of course, we're hoping for today's U.S. jobs news to give us some really good price action. We never know about that. We don't have any way to know exactly what will happen. I wish we did. Wouldn't that be nice? So we'll see how the market will react, but Eusebio has the max charts ready, and hopefully you'll get to see how we take advantage of what the market can provide. We really appreciate the opportunity to show you how max trading methods take advantage of movement in the markets whenever it happens, and we like to be ready for that. And I think, in my opinion, it's at least as important that you'll get to see how our risk management protects the account balance. Just one more reminder, if you would please remember that this is not a trading room. We are not providing trade calls. So nothing you see or hear in our webinar today is to be taken as entry or exit advice or recommendations. All of it, everything, is for educational purposes only. We really appreciate Eusebio being here to take us into the charts for this NFP session. Some of you are new to Max and you've not had a chance to meet Eusebio yet. Others of you have been with him many times, but if you're new, you'll soon discover that he is a very highly skilled trader and that he really enjoys helping others. So this is a good opportunity for you to learn if you will just listen and watch carefully today. And by the way, everyone, if you would, feel free to ask questions in the question panel. That's part of your GoToWebinar window. The methods that you will see today are taught in the Max courses, which begin next month. However, you can choose to begin your training anytime just by using the video playback of our class sessions. We do provide some really nice discounts for anyone who takes the time to attend our webinars or to watch the video of the webinar, and I'll post those discount links for you. Eusebio, I think that's all the preliminaries, so I'm ready if you're ready, and thanks again for sharing your time with us today.
My pleasure, Craig. Thank you for your introduction. Hello, everyone. I hope you are doing fine. We have, so the non-farm payroll news release in a little less than 10 minutes now. Let me show you what we can expect to do. So the non-farm payroll is one of the most complex news to trade when we want to trade that news, and it is made in fact of two news releases, the non-farm payroll itself and the unemployment rate, and the big boys always analyze these two news together. This is why it's a complex news, and in order to have a directional and sustainable movement, we need to have a big surprise in both the number and in agreement. For example, we need to have a big positive deviation in the non-farm payroll itself, and by big positive deviation I mean a number larger than the forecast by 40 or 50K, and we need to have a smaller number for the unemployment rate, because a smaller number for the unemployment rate indicates an improvement in the labor conditions. Or vice versa, we need to see a negative number, a negative surprise with a big deviation in the non-farm payroll, with a smaller number by 40 or 50K, and a larger number for the unemployment rate. So if one of these two conditions are fulfilled, then we have almost always a sustainable and directional movement which can last several hours, 3 to 6 hours in fact. In all the other cases, I consider this is not a trading or a tradable event, because the movement becomes more, I don't like to say random, but more difficult to analyze, because even the big boys don't have necessarily all the conditions to add to their trades or to keep their position or to define new position, and so to define these new this sustainable movement. If we have such a movement, and so we have a positive or a negative surprise, and we get such a movement, sometimes even with a big surprise we don't have a movement. This is not frequent, but it happens. I will show you if one of our pairs or one of the pairs I'm showing on my screen is moving. I will show you how with the max we can handle these movement. And if we don't have a good movement, I will show you how the trade risk management aspect of the trade of the max helps to minimize any negative effect of forcing a trade. By forcing a trade, I mean taking a trade when the trade makes no sense. When we don't have the conditions for the trade and a trader wants to take the trader is forcing the trade. And most of the time when a trade is forced, it becomes a losing trade. Sometimes a profitable trade, but most of the time a losing trade. And so if the trader doesn't have a nice, good trade risk management, the losses may be rather large or relatively large, and I will show you with the max how we can mitigate these losses. So this is the scenario I have just described. So we will have, just to see, another difficulty we have with the non-farm payroll, which is not always represented in an economical calendar, is 2 minutes after the non-farm payroll we have the revision for the previous months. And sometimes this revision can also create some perturbation in the way the market can move in the case of a surprise in the non-farm payroll and the unemployment rate themselves. So this means that we have to take our time. In the case of potential movement, we don't need to run to be in a hurry. We will have plenty of time. And the pair I'm considering is, or the list of the pair I'm considering are, of course, two US dollar pairs, the euro US dollar and the pound US dollar, and then other pairs which can move to, mainly because of the pound and the CAD, because for the CAD we have also the equivalent of the non-farm payroll. And so I have made a small selection here: the pound yen, the pound Aussie, the pound Kiwi, and the pound CAD. These pairs are selected based on what we have on our news watch list. You know that you can go on our website, maxtradingsystem.com, and we have a section called News Watch List. You can push on this button, and every week we update the news we consider day after day, the news we consider really important. They are labeled as major, and we can see that for today we have the non-farm payroll here with the unemployment change to the unemployment rate and the non-farm payroll itself. We have the equivalent for Canada, and for the London Open we have had the pound manufacturing production. And so based on this news also, day after day we suggest some pairs to monitor, and we can see that for today the suggestion was the pound yen, the pound US dollar, the pound CAD, the pound Kiwi, and the pound Aussie. And of course I add the euro US dollar because the euro US dollar is the most traded pair among all the pairs, and so it's a major, so it's a must to monitor that pair. So I will monitor only 6 pairs today, and so let's wait now in 3 minutes for the news release itself. For the chart I'm showing our max primer, the max ETF primer chart, which is made of some, let's take for example the pound yen, which contains some tools we use. Among the tools we use and which are part of the context, the global context, we have these vertical lines showing the open and the close of important market. For example, we have faced the US Open. This red vertical line represents the non-farm payroll. The 5 news we have at the same time, so 3 on the US dollar, 2 on the card, and then the Wall Street opened, and later the close of Frankfurt and London. And then we have some of our indicators, and the main one are the two ETF lines here, which capture a nice movement among trends. If we scroll through that, you can see how they nicely catch the movement. And we have our bias directional indicator, which tells us in which direction we have to take our trade. And for the moment, but we have to wait for the news release, for the moment the bias is the upside on pair like the pound yen. So if we have some interesting situation, I will illustrate also how we can handle these movement with one of our version of the MAX. I mean the MAX ETF SAM, and possibly also our MAX Trade Monitor, which is our expert advisor, which help to execute our orders and which help to adjust our stop loss manually, which help to make our opening trade, scale out, scale in when we use the scaling process, and in a one-click button, and which gives us some important information while we are handling the trade, the corresponding trade. So the news is in now 45 seconds. I will display the calendar here. Let's make an update. We should see the small green button in front of this news release. Yeah. And I will click on it once the news is released. Normally, if we have a surprise, we should see some speculative movement. I will explain while we are waiting the typical movement we have in the case of surprise. We can see that the price begins to move a few seconds before the news release itself. Okay, the news must be released now. Let's wait for the update in the calendar, and so we will look for a big deviation in the non-farm payroll and a corresponding in agreement number in the unemployment rate, so in order to have a tradable situation. The average hourly earnings is a smaller number, so this is a negative number. It may contribute in the case of a surprise to the non-farm payroll. For the CAD, we have no surprise at all. The unemployment rate is better than the forecast, but the unemployment change, we don't have a real big number here. So for the unemployment rate, we have a worse number than expected, so a negative number. And so to have a surprise or a big movement, we need to have a smaller number by a large deviation in the non-farm payroll itself. And then in a few seconds we will have, okay, 313. We have a big positive surprise in the non-farm payroll, but a negative number in the unemployment rate. So this, we don't have the two numbers in agreement. So for me, this is not a tradable situation. We may, however, because of the non-farm payroll itself, see perhaps some improvement in the US dollar. But the movement should not be normally as clear as if we would have had the two numbers in agreement. So for me, this is not a tradable situation, as we have seen. We've seen approximately half of the time on the non-farm payroll. It's several months now that we don't have the numbers in agreement. So what I will consider is, let's wait for the volatility to settle down. And then what I will show you is how we can use the trade risk management aspect of the MAX in the context of a forced trade, how that forced trade can be handled, or how we can mitigate the negative consequences of a forced trade. And of course, I will consider to take the trade in the direction of the trend. And so we can see for the pound yen, for example, that the trend, which was previously upward, has turned to the downside now. It's not over yet. And let's have a quick look to the other pairs. Yeah, it's unfrozen. So let's see, the euro-US dollar is going for the moment upward. Let me explain the typical movement we see when we have a news release in the context of a big surprise. So this is not the case today, but usually when we have a big surprise, we have typically three types of movements. First of all, a fast spike in the direction of the news. So, for example, if the news has as a consequence a strengthening of the US dollar, we will see usually a fast spike to the downside on pairs like the euro US dollar, the pound US dollar, or to the upside on pairs like the US dollar yen, for example. Then the second step is we see a retracement, and a retracement deep enough to completely or largely erase the first spike. The first spike is always a speculative movement. And then after sometimes, and sometimes mean it may be just a few minutes or it may be 1 hour, 2 hours later, we will see the price moving again in the direction of the news release, and we call that movement a fundamental movement. So this is the typical behavior we have. Sometimes we have a pre-movement before the news release with some anticipation. It is not the case with the non-farm payroll, but with some other type of news this may happen. And the reason is because the big boys have better informations, more detailed information than the retail traders, and they can adjust their position before the news is released, taking into advantage some pockets of liquidity they may discover while moving the price before the news release. But this is not the case. So here today, this type of typical behavior doesn't matter because we don't have the conditions for a sustainable and directional movement. So let's see what we may possibly have once this volatility will be somewhat slowed down. So I propose to wait for the close of this present bar in around 3.5 minutes. And then I will switch, depending on the pair, I will switch on our max ETF sum charts, which are in fact a constant range bar chart, but with specific size for the range bar. In the meantime, let me explain quickly what we have on our news watch list. So this is the list of the news we consider important for the entire week, and we update that list every weekend, every Saturday. So the list is updated and it is followed. So there is an explanation how to interpret these informations, of course, and it is followed with what we call the top 10 pairs list, which gives a list of the best moving pairs, or recently the best moving pairs, and then the suggestion we have day after day during the week. So all these informations are updated every Saturday. So tomorrow we will update these informations for next week. And because the pound yen and the pound US dollar are in the top pairs for the suggested pairs for the Friday, I suggest to follow the pound yen and the pound US dollar pair. When we consider the pound yen, we can also consider either the pound Aussie or the pound Kiwi. Sean, I have explained that we are not in a clear situations. We have a good number for the non-farm payroll itself, but not a better number for the unemployment rate. In order to have a logical movement in the pairs, we need to have the two numbers in agreement. It is not the case, so the movement is way less logical. So, and this will depend on the positions the big boys have themselves and their own objectives. I have explained that in order to have sustainable and directional movement, we need to have the two release in agreement, either a positive big number in the non-farm payroll and a negative number in the unemployment rate, or vice versa. A big negative number in the non-farm payroll and a positive number in the, or a larger number in the unemployment rate. Okay? In all the other conditions, it's not an easy situation to trade. For me, it's not a tradable situation. And so this is the case today. And this is why the non-farm payroll is one of the most difficult news to trade. So I will consider here, let's say, the pound Aussie, because the pound Aussie has turned to the downside. We can see that our bias directional movement has turned to the downside. And so what I will do, I will switch to our sum chart, which is given here with this chart here. And I will stop, for example, for the pound CAD. I will save some resources on my PC for the pound Kiwi. And I will stop also for the, let's say, the euro US dollar, that way. And I will keep, we never know, the pound US dollar and the pound yen. Now, what I'm going to do is rearrange my screen that way. And I will show that way. So this is what we call our sum charts with a simplified template and possibly additional tools. We can see that the bias is to the downside. This means that we are looking for short trades only, and when I will see an adequate short setup, I will show how we can handle that movement in terms of our trade risk management. And for that, I'm going to open the max trade monitor, so here, and I will use my usual settings. So 1% risk for the trade. I will not number the trade. I will not make notations on the chart. And so I click on OK. And normally we will have two panel opening very soon. I have to check that the one-click trading is allowed. Okay. Sometimes it takes a few seconds for the panels of the MTM to open. Let me check if they are not in the other screen. No. Everything seems okay. I'm going to reapply it. I'm going first of all to remove it and then to reapply it, because I had to adjust the one-click button. Max trade monitor here. Load my MTM settings. Okay. Okay, now we have the two panels opening, and I will explain the content of these panels. Let me first of all reset all the numbers here. Okay, so let me see. We may have here, yes, a setup. No, we have to wait. I will move my stop loss a bit lower. So this small panel is the one-click button panel. I can open a trade with just one click, buy or sell. The name of the button change with the position of the stop loss, buy or sell. And I can make an MX. An MX is a momentum exit. So once the trade is open, the trade is supposed to be made of 2 units, and an MX close just 1 unit, so half of the trade. And the XX close the entire trade, whatever the number of opened units. So, and you have seen that in the properties of the EA, I've mentioned 1% risk per trade. This means that once the stop loss is fixed, and with the risk per trade, I don't need to specify the trade size. The max trade monitor will calculate automatically the trade size when I will push on the sell or the buy button to open the trade using the position sizing concept. Then when we use the scaling process, the same button buy or sell will be used. Now in the large panel here we have some information which are provided in essentially 2 columns. One column, the right column, represents the information for the pairs which is traded, and the global columns represent the same types of informations if we have several simultaneous trades. And the 2 main informations, or 3 main informations, are first of all the size of the stop loss, which is given here at any moment, and this size will change when I move that horizontal level which represents the stop loss. It's always a global stop loss when we have several scale-ins and several scale-out. And then the 2 other important numbers are the ESL result and the XXX profits, or I should say XXX result. The ESL result first. ESL means emergency stop loss. And the emergency stop loss is the stop loss we place on the chart, and the aim of the ESL is to protect the account in the case everything goes wrong. For example, we may have a problem with our internet connection. We are blind for the trades, and so if the price goes hardly against the trade, at least, because this is a hard stop loss, and the risk is calculated on that stop loss, so the trade will not produce a loss larger than the predefined risk, so in this case 1%. Of course, whenever I will adjust the stop loss, I will tighten the stop loss, the risk will decrease. And the XXX result represent, once the trade is opened, the result the trade will produce, a profit or a loss, if the trade is closed always at the present price. And this is why this number will evolve with each new price coming in the data feed. And then we have some intermediary results. So what is the result for the remaining open units? What is the result closed for the closed units in percentages and in pips? And so we have the 2 types of numbers, and so these numbers are helpful to handle the trade in the appropriate conditions. So we can see that the price has made after the news release an important, a rather important down movement. In fact, from the news release here, the spike was approximately 34 pips, not a big one, and I have explained why. And then the price is retracing, and the retracement is almost for the entire previous movement. And so, but because my bias is still to the downside, I'm looking only for short setup, at least for the moment. The only way to consider a long trade would be if my directional bias would turn from red to green. So for the moment, we need simply to be patient and to wait for the price to be in agreement with the directional bias. And you can see now the price is above the stop loss. The button has become a buy button, of course. So it can take time for the price to decide which direction it can the direction it can take. What do you mean by setup on the pound yen? Setup probably on the pound yen. Yeah, possibly done, but because I have to give explanations, so I would like to focus only on one pair. Okay. Let me check on my other screen where I have my entire template. Let me check. So for the time bar chart done, the bias on my screen is still to the downside. So if you see a long bias in the sum chart, so pay attention, they are not necessarily in agreement. Okay? So let's see if we will have the reverse. I would like to see the two charts in agreement. So we have the bias to the downside in both the slow bias. We have the ETF line pointing downward in the time bar chart and now reversing probably at the close of this candle to the downside. Yes, this is the case. Now they are in agreement, and so this candle is a setup bar to the downside. I can fix my stop loss if I'm fast enough, and I will close a rather large stop loss today, and so I will make my entry around this level now. So I will sell now. What we are used to do is when we have an entry setup bar, we draw on the setup bar a green vertical line just to indicate when we exchange chart between the max members charts to show trades or to ask an explanation or to give some explanation. So we have some conventions we are using. And so now the trade is opened, and so you can see the numbers here on the panel screen. You have the result on the trade should the price reverse and hit the stop loss, so the loss would be almost minus 1%. It is not exactly 1% because of course there is always a round off in the size of the trade with a number the brokers allows to trade, and then you have the result on the present price which change for each quotes arriving. This number will stay red as long as the price has not moved in favor of the trade by the spread being around 3 pips approximately. So if the price has not moved more than 3 pips in favor of the trade, this number will stay negative. Now you can see there are two units which are opened, and so this gives us some flexibility to handle the trade, especially when the price goes against the trade. Most of the time we have the possibility to close one unit while the price is moving, because of course we have a set of exit rules we have to use now to control the trade. And most of the time when the price goes against the trade, we can make a close of the entire trade by two steps. First of all, we close one unit in the process of the price moving against the trade, and then we will have the second unit close at some place. And usually when we are able to make that close in two steps, so we minimize the loss we have on the trade. Now, when the price goes in our favor, I will not explain here the scaling process. I will not illustrate the scaling process because we are not in appropriate conditions. So the movements are way more risky because the non-farm payroll was not clear today. So once the trade is opened and if the price moves in favor of the trade, I will illustrate, if this is the case, also an exit in two steps. So closing first of all one unit and then the second unit using all our exit techniques. I will also describe some nuances we have. For example, here we have on that blue candle an exit technique, this is an exit setup. And so normally if some movement is made with the price max greater to good close 1 unit. Personally, I like to describe also some situations I call discretionary situations. A discretionary situation is a situation when we can not exactly follow the rule. We can deviate from the rule, but not in a subjective way, always based on a trade risk management aspect. And what I call in this case discretionary situation is the following. Personally, I am always a very risk-averse trader, and in the past and on several thousand trades, when I had an exit condition, I was systematically taking that exit. So here, I would have made an exit should the price comes around this level, which has not been the case. But let's suppose the price would have moved on that level. In the past, I would have made my MX strictly following the max rules. Last year, I have made a big statistical analysis of all my trades, and I have realized that being a very risk-averse trader is not always profitable when we have a good trading process. And I have realized that should I would have taken my MX, my first MX, with a profit large enough, then of course whenever I would have had a losing trade, the loss would have been a bit larger, but globally on the long term my profit would have been way larger. And so now for my first MX, I don't take it systematically, I take it only if my profits is large enough. I would handle the pound CAD exactly the same way. Should I see a short setup DDIP, I would take a short trade, and then I would handle the trade normally, because the bias is to the downside. Just follow the rules. The bias is to the downside, so look only for short trades. Okay? So when I see a profit large enough, my stop loss size was here 22 pips plus the spread, so approximately 25 pips. Normally it should be written on the charts here. Let me see if we can see. No, the notations are a bit too small, but it is around 25 pips with the spread. Let's say 26 pips. And a profit large enough for me is at least half of the size of my stop loss. So 13 pips plus the spread, so 16, 17 pips. Let me draw an horizontal line where I would like minimum to take my MX if the price should follow on that level. So I have set 17 pips, so right on this level approximately. And so in the meantime, I will ignore all the other exit conditions. Now I have to take 13 pips because I am on, let me check. No, I am in a short trade, so I have to take into account for the ask price. So indeed my bid price should come here on this level, so 63660. So right here. So the price must reach at least that level or below that level for me to take an MX when an exit setup is given. So I'm going to watch on my complete chart how I can adjust my stop loss in the case a stop loss can be adjusted. So for the moment there is no reason to adjust the stop loss. I must keep my stop loss above that red line, which is red for a short trade, blue for a long trade. But because the pair is a rather volatile pair, we do not tighten the stop loss too much, because a fast spike can hit the stop loss too early and close the trade too early. we have to be patient. If it is a losing trade, it's a losing trade. But if it must be a positive trade, it would be pity to be stopped out too early because the stop loss is too tightened. And so we need, as a trader, to be able to sustain these pullbacks the price is regularly making while it is moving. The pullbacks are normal movement when the price is moving in a trend. And one important exit rule we have at our disposal, which is an important one, is should the trade makes no longer sense because the trend is reversing, of course we close the trade, whatever the result will be. There is no way to use any discretionary rules when the trend changes. Of course, when the trade makes no longer sense, we have to scratch the trade, whatever the result. You can see small white arrows on the chart, up arrows or down arrows. They simply indicate when our two ETF lines, ETF means extended trading format, cross. When they cross downward, we have a small down arrow. When they cross upward, we have an up arrow. Yeah, this is what I'm showing, Sinisa. This is a forced trade because we don't have the conditions for a valid trade with the non-farm payroll. So this is what I don't say we will have necessarily a losing trade, but very often when we have a forced trade, the forced trade ends as a losing trade. Okay, and so if it happens we have a profitable trade, so it's better. But if we have a losing trade, I will show you here. We don't have price levels. We have price levels which are far enough. You can see here they are far from our entry level, so at almost 50 pips to the downside and far away to the upside. The max price levels are price levels or supply and demand price level I define every weekend. And when the price reaches these levels, they are also good tools to tell us when we can, for example, lock some profits, or when we have to open the trade if we are on the right side of the price levels, or on the wrong side, or if we have enough potential reward to risk ratio. So let me read your entire question, Sinisa. So in case of forcing trade, I guess you mean losing trade. Can you please explain what you would do in case of losing trade, or you already described that a short time ago? I have described that indeed. Would the stop loss, however, that's any other special risk handling. Not all the traders do that, so I'm not sure what did you mean. Okay. But this is precisely what I'm going to explain. I'm using here for the first MX my discretionary situation. This does not mean that, for example, let's suppose I am able to close an MX here with a first profit. Okay, it may happen that the price reverses and hit the stop loss, and this will still make a losing trade. Being able to make the close of the trade in 2 steps with an MX and then an XXX, following the rule, using a discretionary rule or not, will help us to minimize the trade. The only way we cannot minimize the trade is if we are forced to close the 2 units on the initial stop loss. In this case, we make a full loss, in this case of 1%. In all the other cases, the loss will be smaller. Okay? When the price will cross my minimum profit, because we are not in a appropriate context for a trade. We are in the context of a forced trade. The trade risk management here tells me that if I had the luck for the price to reach my minimum profit, it's a good point to lock that profit, and I will close one unit. We can see that we have almost an exit rule. We have an exit rule preparing here with the slow RSI indicator. The price has failed to hit my level, so too early. At the close of this blue candle, if it closes as a blue candle, yeah, this one has closed as a blue candle, we still have an exit rule triggering, but because my profit has not been reached, I will not take that MX. I want to take my profit here on this level. And it's not a bad level because when we see the price action here, the price was ranging in all that area. We are in that area. So that area may be possibly a resistance area of the price behavior. The bias is still nicely downward in both the time chart and our sum charts. Okay, let's be ready. Okay, I'm making an MX here. So the MX has been made on this level. You see the small triangle. So my profit on that level has been 14 pips, a little more than half of my stop loss. This means that you can see I have locked a profit here of close profit 1/3 of %, which is a little more than 1/4. 1/4 indeed, because the profit was half of the stop loss, and because we use 2 units, we have to divide the result by 2. So that unit contributes for half of the trade. So half a percent is 1/4 of a percent. I have been able to lock a little more than half a percent because the price has moved a little lower after my level. We are in a short trade, so closing one unit is equivalent to a buy, and a buy is always made on not on the bid price but on the ask price, and MetaTraders always show the ask price. Now you can see that the trade is still at risk. In the worst case scenario, I can still lose minus 0.16%, so a very small loss. This is due to the nice MX I have made here. But now, because the price has moved in our favor and continue to move in our favor, by reducing the risk, and for that I have the possibility to adjust my stop loss, I can make that trade at minimum risk-free or break-even. So indeed, if I progressively tighten the stop loss, you will see that this risk will decrease as soon as the panel will be updated on the next price quote. With the second unit, Sinisa, we have, as we described in the course, 2 possibilities. Either we close it on the next exit technique, which gives us the opportunity to open another trade on another entry setup, or we can wait for the trend to reverse. So we can keep the open unit until the trend reverses. This allows to make less trades. They would be usually less stressful. On the long term, the 2 approaches are identical in terms of profit. We have time obligation. Yes, this session will be... Oh, let me show you first of all here. I have tightened some of my stop loss, and you can see that the risk has been tightened almost to break even, I can tighten it further somewhat until we are risk-free. And I can even try to make it break even plus something. And a good rule is to keep the stop loss large enough but still above that red line. And so I will move my stop loss right in this area, locking more than 1/3% profit. So we have time limitation. Time limitation will be maximum 2 hours from the beginning of the session, Ralph, okay? Yes, Maurice, the video is recorded, the session is recorded, and the recorded video is made available to all the participants, for all who have enrolled in this session, either they are present live or not, because of course some of the participants will wait only time to watch the video, the recorded video. No, M2 is not a lower time frame than M1. Vincent, what I trade usually is the 5-minute time frame. M2 is a pseudonym for a time frame. When we generate a constant range bar chart, which is an offline chart, it may be a constant range bar chart, it can be a rainbow bar chart, it can be a tick chart. We have to define a pseudo name, a pseudo time frame, and we can give it the name M2, M3, M4, M6, M7, any name which does not correspond to a standard time frame. Just in a way that a MetaTrader can recognize the offline chart as a usual historical file. Okay, and this time frame corresponds to it's a constant range bar chart with a special way to calculate the range size corresponding to the 5-minute time frame. This is why most of the time the two charts will be in agreement. Okay. Now, as a rule, the rule I will apply, so now here is I will make an XXX on the next exit technique I will see on my chart. For those of you who already what the max is, you can see that in this area we had with the store RSI another exit technique, another exit rule triggering, but I have not made the XXX because I'm using the rule of the time window. The time window being a time window during which we take only one exit when several exits happens. So now with the price continuing to move in our favor and that red line moving in our favor, I can tighten somewhat my stop loss, locking more profit. You see, let's see if I can tighten it until to lock 0.5%. Okay, I have, I'm locking here now 0.5% and I still have one opened unit. And so I will close the second unit when we will have the next exit technique. And for the exit techniques, we have exit techniques either with our indicators here or with some price action behavior in the time bar chart. So we have several categories of exit techniques. So using indicators, using price action pattern, using a combination of indicators and price action to analyze in detail some aspect of the structure the price is developing, using time aspect. There are times consideration too. And there is one important rule, two important rules which correspond, one for a movement invalidation, what we call the concept of a movement invalidation, and the second one, the trend reversal. There is a small difference between both. When we have a movement invalidation, this does not mean that the trend is reversing, but the movement we are trading makes no longer sense for the trade, and the trend reversal is when the price makes an attempt to reverse. We are never sure 100% that the trend will successively reverse, of course, but at least we will see an exhaustion of the movement inside of the trend we are trading. Sinija, the rule of the time window, you should know. You should know what is the time window. We explain that on every scrolling party we have, almost every exit scrolling party we have every Saturday. But just to make it simple, you see the price is making a bottom here. Okay, and the exit I have made is while the price was making that bottom, perhaps too early, but it was based on my minimum profit level. And inside that bottom, if we have several exit rule triggering, we take only one of the exit rule. Okay. And so this means that in order to have another exit rules, we need to see the price making another bottom, or the price to invalidate the movement or to reverse the trend, because everything may happen, of course. In this case, invalidating the movement will be the following condition. Should the price cross and close above this red line, this candle then will constitute the setup bar for the movement invalidation. And if that condition occurs, I will define where I will make my exit, and if the price hits that exit, I will close the trade. Okay? But it seems that the price wants to make another bottom, and that's good because we can see that especially here, we have nothing special on the time bar chart, but here we may have possibly, it will depend how deep the movement will go. But if we have an exit setup triggering with our store RSI here, I will close the second unit. Yeah, Manole, our ETF sum chart are a little bit simplified, and we can even simplify it further. For example, we can delete that line here. We can delete possibly that one too. So we can delete several of our lines on the chart. But I still like to keep an eye on the corresponding time bar chart, because a constant range bar chart does not always indicate all the features we are interested in, and these features are shown in the time bar chart. For example, a very important exit rule we have at our disposal is when the price is making a long bar, a long candle, a large candle, so we call it a long bar. And a long bar can never be seen in a constant range bar chart, except when we have experiment, we can see the fast succession of bars with no wicks. A long bar is better seen in a time bar chart. And this is why I like to keep. And when we use a complete template of the max, we can see also when the price is reaching some extreme levels. Extreme levels where the odds are larger for the price to, not necessarily to reverse the trend, but to create some retracement. We call them, for example, either the max price levels or the TT lines. You all know our TT lines. So here we may have at the close of this blue candle an exit setup bar. Let's see and wait. We can use them, Sinija, for every chart. I described them for the max, the ETF sum, but when you are experienced with them, and if you like them, you can use them also for the time bar chart. There is no problem for that, especially to adjust the stop loss. Okay? It's a nice way to trail the trend, to trail the movement, in fact, if we use the appropriate setting of that line. We can see that the setup is ready to be formed. And when I am in a trade here, I never ever pay attention, or I should never say I never ever. I don't pay too much attention. This is much more correct. I don't pay too much attention to the XXX profit, but I pay a lot of attention to the ESL result. So now, being in a sure profitable trade, even in the case of a forced trade, I can feel completely comfortable in that trade. Now, with the price continuing to move in our favor, I can tighten somewhat the price, but not too much. I keep my stop loss above that red line. And you can see that now I have locked 0.58% profit. For the participant who has mentioned the pound card, you can see that the pound card becomes a little more difficult to handle. So we have for the pound yen a nice, we have seen a nice trend reversal to the upside. So we have approximately a similar movement, but in the opposite direction for the pound yen. Okay, this blue candle is an exit setup bar, so I will make my exit. I'm going to show exactly where I'm going to make my exit at 006, so we'll be at this level exactly. If the price follows through and hit that level, I will make my exit because I have an exit setup bar with that blue candle. And so our entries and our exit are always made into two steps. First of all, we wait for a setup bar, and the setup bar must always close, and then we define where to exit. Okay, I exit the trade, and so you can see that the price is executed on the ask price, of course, and this trade has closed with 0.75% profit, with almost never a drawdown during the trade, but it was a forced trade. Okay. Charles asked, is there any chance you could please share the setting for the Renko chart? I don't use the Renko chart here. I use a constant range bar chart, Charles. And the size is not a fixed size. It is calculated with a very specific procedure, which we call the volatility equalization process, and this is one of the main points we explain in the Max ETF SAM course. And so it may be, I can show that, for example, here for this pound Aussie, the size of the range bar is 3.9 pips. But tomorrow it may be perhaps 4 pips. The next day it may be 10 pips. It depends on the volatility of the moment. Okay? Well, so this trade has been closed with, let's say, 0.75%. When we trade trends with the max, one of the most common questions which is asked is, isn't it a problem if you trade pairs with a large spread? And when we trade trends, in fact, the spread, of course, always has an effect, that it has a smaller effect. Look here, this was another entry setup to go short. So, but while I'm explaining, I cannot pay attention to this detail. But let's see. Let me draw a vertical line on this candle and see what the price has made after that. Because trading with concentration, this would have given a second trade. Okay. You're welcome, Vincent. Yeah, because in fact, you can see a lot of trading systems based on constant range bar chart or on Renko bar chart. They are pretty much similar. The difference between the Renko and the constant range bar chart is the Renko cannot overlap. They may have wicks and tails, of course, smaller than the size of the brick or the size of the candle, but they cannot overlap. A constant range bar, on a constant range bar chart, the candles may overlap. That's the only difference. And because they are based on only the movement of the price, so they better take into consideration the momentum of the price. But of course, that momentum is influenced by the volatility of the instrument we are trading at that moment. And there is a way, however, to calculate the size of the candle not to eliminate the volatility. We can never eliminate the volatility, but we can neutralize the volatility as if the volatility would be kept constant along the chart. This is the idea behind the volatility equalization process. In such a way, we don't need to pay a lot of attention to the volatility, only to the movement the price is developing in terms of momentum. Okay, and so Dilip asked, would you set now the pound yen, which was walk across the board, is looking for reversal, and so if in trade caution tighten, but Dilip, I would like to ask you to write your comments or your question a little more carefully, because I don't understand what you are writing. So, we need to be careful, indeed. How would you say? Okay. So, which was work across the board is looking for reversal, and so if in a trade caution tighten, but Friday, so no gambit. We never gambit anyway. Of course, if we observe the chart, for example, the pound US dollar has made an attempt to create a new uptrend, but the price is reversing. The pound yen is in an uptrend, the pound Aussie in a downtrend, the pound Kiwi in a downtrend, the pound Swiss in an uptrend, but the price is not moving a lot, and the pound CAD in a downtrend. So we can see that on almost all the pound pairs, the pound is shorted. So except for the pound yen, but the pound yen can reverse quickly. So we have to pay attention, and because all the other pairs, the pound pairs, are shorting the pound, so waiting for the pound yen to develop a new downtrend and waiting for a short setup could be a good idea. But again, we are not in the context of directional and sustainable movement with the non-farm payroll. So the movements are way more challenging to handle. In such a case, for the traders who want absolutely to take a gamble in this case, I would say use a smaller risk. Don't use scaling, and be very careful to your exit. In fact, one good way to trade this kind of riskier trade is for the Max members, you know that at the end of each Max courses, I make a demonstration with 3 types of trade: a losing trade, a winning trade, or several winning trades, and a trade in a choppy mode. So what you can do for this kind of trade, if you want absolutely to take one, handle it as a trade in a choppy mode. This is what I have made here. Of course, the discretionary rule I'm using is sometimes, I don't describe it necessarily systematically in our courses. I explain it in our scrolling parties and when we have our free live session. But this is a rule, a powerful rule you can use in choppy mode, for example, and especially when it is in relationship, as I have explained briefly, with a potential area of resistance we had here. See, because my level was right inside that level, and you can see that when the price has reached that level, the price has made some hesitation here, and now the price is breaking that level. So there may be some potential to the downside, and this is why, even if I have missed it in life, I have drawn where we would have had our next entry setup, and I will show where the exit would be. Now, when we trade with the Max, and because we have very accurate entry and exit conditions, so there is no need necessarily to chase large movement. Even with small movement, when we are accurate, we make, of course, profit, which may be considered a small profit. Remember, my risk was 1%. But even in a non-appropriate condition, the profit has been decent, 3/4 of 1%. If you are able every day every day to make on one or several trades in one or several pairs. The number of pairs you monitor doesn't matter. The number of trades you make doesn't matter, in fact. But as long as you are able to make an average result of half a percent per trade, per day, half a percent per day, and if you trade every day, there are approximately 250 trading days in 1 year. So at the end of the year, by the compounding process, you triple your account. If you are able to make 1% per day, 1% per day, at the end of the year with the compounding process, you multiply your account by approximately 10. There is no need to chase for big reward to risk ratio. It is way more important for me to trade in the condition of the global context. So if you take your trade in agreement with the global context, then you will make many more profitable trade than losing trade. And when you apply the trade risk management of the max correctly, whenever you will have a losing trade, the loss will be always a very small loss. Rarely a full loss. A full loss is the 2 units are closed on the initial stop loss. And more generally, between minus 0.2 and minus 0.6 R. So around, on average, half R negative as a loss. And so the losses are very quickly recoverable, and so you just need to focus on the process to handle a trade as correctly as possible. On 3 aspects, the technical aspect will give you your potential entry setup and exit setup. The risk aspect, because of course you all know that a risk must be small enough. But what does it mean for the risk to be small enough? You also know that concept which tells that a trader must not have too big expectations. But what does it mean, not having too big expectation? What is a reasonable expectation? What is a reasonable risk? What is a reasonable expectation? And so for the max members here, I'm preparing what we have sometimes a max mini course when I will deepen these concepts. And then the technical aspect, the risk aspect, and the global context aspect. If you focus your trades in agreement with the global context, you will have fewer losing trades, and most of the trades will be profitable trade. Even not using the scaling process, you will nicely increase your trading account. In this case, I would set my entry somewhere in this. I would have set my entry somewhere here, and I would have placed my stop loss somewhere in this area, so a stop loss of around 25 pips with the spread. And so my level for the MX would have been approximately on that level 13, 16, 17 pips, approximately on this level. So Sinisa asked, now you are talking about it when trades close first unit at the first exit sign, right? Yeah, indeed. What we advise to our max traders, as you know, Sinisa, is using a discretionary rule when it happens needs some need for the trader to feel comfortable. And this is why discretionary situation must always be analyzed in terms of the trade risk management. Until the trader does not feel comfortable enough with that aspect in trading, what we advise is whenever you are in a trade and an exit setup appears, make your MX, whatever the result of that MX, because this really helps to minimize the loss for a losing trade. And this is an important rule. The most important rule when you trade is to keep safe your money, not to lose your money. And one concrete, practical way to save your money is when you have a losing trade, keep the losses or the loss as small as possible, while leaving place enough for the price to move. And this is why when we have an MX, whatever the result of that MX, the advice is make that MX. For example, here in this case, this blue candle here would have been an exit setup, and the price would not have reached the exit level, but we would have had another exit setup on this candle, and the price would have reached the exit level in this area. So here an MX would have been made almost break even, except for the spread. Okay? This means that should that trade turns into a losing trade, the first unit would have been closed with a loss corresponding to the spread, so neglectable, and the second unit, if it is closed on the stop loss, I would have placed in this area, would contribute only for half of the loss. So the loss would be maximum half R, minus half R, or better if the stop loss along the trade is adjusted. And you can see that there was place enough to adjust the stop loss along that red line. For example, placing the stop loss in this area, the maximum loss on the second unit would be around, let's say, 7 pips, and the spread, so 10 pips. 10 pips would represent approximately 1/6 of the size of the stop loss in terms of risk. So the loss in any case would be extremely small. And what I can do just to illustrate that concept, I'm going to mark the chart. So the entry would have been made live in this condition. The exit would have been given on this blue candle, so the exit, let me mark the chart correctly. So the entry would have been made at 943, so a bit lower, so here. The exit would be made at 947. 947 would be right on this place, right here. Let me mark the exit here. Okay, so this means a loss here of, let's say, half a pips plus the spread, which is 3 pips, so minus 3.5 pips. Let's write it minus 3.5 pips. Okay, the stop loss would have been in this place, so 25 pips. Let's write it here, ESL 25. This is the initial stop loss. Okay, and now the stop loss would be adjusted, so somewhere in this area, well above that red line, and so showing a maximum risk on the second unit of, let's say, 12 plus the spread, 15 pips. So a loss of 15 pips plus 3.5, so 18.5 pips. 18.5 pips in the worst case scenario would represent a minus 0.37, so approximately minus 1/3 of 1 R, or percent in this case, because the risk is 1%. But with the price continuing moving in favor, either we will have an exit earlier, or we will adjust the stop loss further. Okay? So this is what we advise to our max graduates, to operate the trade, to handle the trade, as long as they don't feel comfortable enough with what I call the discretionary situation, which is exceptional. It doesn't happen always, of course. And as I have said, it is not subjective. It is always based on the trade risk management aspect. Yeah, Nicole, 0.5% per day with the max is very, very conservative indeed. And so it's really, I should say, when you master enough the max, it would be difficult not to achieve that result. Okay, especially when you trade during the European session, starting with the London with the London Open. Okay, see you, Dilip. Nice to have see you in this live session. Those blue bars were TT rejection at time bar. Yeah, indeed, I see that it was a nice rejection, and we have again another attempt here for the price to reject the TT number 1. So this blue candle is an exit setup bar, and so the exit on the next bar would be here at that level 945. So the price has already reached that level, so the exit would have been here, approximately at the same level as the previous one, but using all the subtleties of the max, as one of our members has mentioned, with our TT line in this area, the exit would have been a little earlier. But I prefer to show the rules. Many of the max graduate, primer, light, or standard nose. So we have the same loss in this case, approximately. And you see here, the price is no longer moving for the moment. The price is again ranging. And so this would have been a losing trade. And that losing trade would have produced a reward to risk ratio of minus 0.14 R. Minus 0.14 R. So really a small result, a smaller loss than usual. Okay? And because the risk is 1% in this case, so the result in percentage would be minus 0.14% too. And so once the trade is closed, because the trend is still to the downside, so we wait for the next short setup unless the trend reverses. Okay? And we can make, especially when we use a chart like the ETF SAM chart, we can make during the European session on average for each pair between 3 and 10 trades per day, which is a lot. And so, and we can trade several pairs. I like personally to monitor between 4 and 8 pairs, depending on the day, depending on the news we have for that day. So between 4 and 8 pairs. But an important rule I have also is I never handle initially more than 2 trades simultaneously. Why? That's really simple to understand. Let's suppose that I have a risk of 1%, let's say R equal 1% per trade, okay? 1% per trade. And perhaps another exit setup bar will come here at the close of this candle. Yes, this is the case, but we are in a concession zone mode here, so we have to wait for the breakout of its support level, which is here. So our max trader knows how to handle that situation. For the moment it is placed here. It will depend what the price will do here. So now let's come back to my explanation. Let's suppose we have a risk of 1% per trade. So when we use the scaling process, the risk per trade can temporarily increase. And I never ever allow to have a maximum risk per trade of, so max R, never more than 2.5 to 3 R. Okay? This means that at any moment I can only open a maximum 2 or 3 trades. I like to use 2.5, and so I will adjust that number, so 2.5 R. This means that at the beginning of my session, or when I open 2 new trades, I can never open more than 2 trades simultaneously. Now, while the trades are live, of course, if at some point one of the trades becomes risk-free, this means that I have placed enough in terms of risk to open a new trade, so I may have 3 trades simultaneously open. The rule is to never exceed my global risk at any moment. Now, personally, I never handle more than 3 trades simultaneously because it becomes really difficult to handle. It requires a lot of concentration, a lot of focus, and so it becomes difficult and so dangerous to handle many trades simultaneously, because all that are made manually, but with that tool for each pair we trade, it is easier, but we still need to pay attention, because what may happen, which make trading even more complex, we may have, for example, one pair with a short trade and another with a long trade, so in the opposite direction, and in such a case it's so easy to make some errors. Nicole says, Dilip says, once someone makes it 0.5% per day, then make one for 1.5 session, then far more than 10 for 2 sessions. Yeah, indeed. Now, with more bars on the chart, we can adjust our support level, and in this case, I will adjust my support level in this area. For those of you who know how the max is working, you know how we set our support or resistance level. And we are in what we call a tight consolidation zone mode. A new trade can be considered only if the price breaks that level. The price must go outside the consolidation area. Knowing that we will face something else, we are progressively approaching the European close market. And for a pair like the pound Aussie or the pound yen or the pound Swiss trading, that these pairs during the second half of the US session, and especially a Friday, with no event with a non-farm payroll, in fact, it becomes worthless to invest times to find good trades. And so this means that while we are approaching the Frankfurt close, the odds for another trade will decrease largely. And there is a time limit when we will consider no longer to open a trade. So we still have around a little less than half an hour. Any questions about what you have seen up to now? So the first trade, let me write on the chart, the first trade has been closed with plus 0.77 R profit. What is happening? 0. R. Okay, and should have I taken the second one would have lost 0.14 R. So globally, you can see the result is still very positive, more than half R. Any questions about what I have explained today, what I have shown today? And you can see that even when we have more complex movement on a time bar chart using our max ETF sum chart, the sum chart is another way to name the constant range bar chart. It's shorter, it's easier to pronounce for me, and I use that name because we use a special process to define day after day the size of our range bar. So even if we have a more challenging movement, and not especially a large movement, this movement starting from this open to this close was a movement of only less than 40 pips. So with the sum methodology, so we are still able to catch decent profit, even not using the scaling process. When the conditions are not appropriate, of course, we never use a scaling process. Yeah, pound Aussie was now just 1.6 R. Oh, perfect, done, perfect. Yeah, it depends how you handle the second unit, and it depends if you use scalings. Okay, as I have said, we have two alternative ways to handle XXX, either, or as I have shown in this example, it was here somewhere in this area. This was a first exit, and the second one was where it is. It was somewhere in this, yeah, it was here. That XXX closing the second unit, you can choose to close it later, either when you have, for example, a tiger tunnel rejection or when you have the trend reversal. And so this will provide you sometimes a larger reward to risk ratio, but on the long term, they will be the same, okay? Some chart can handle some tweets. You are using the ETF standard chart. Okay, that's fine. Oh yeah, then making your MX at the tiger tunnel rejection is a nice exit, indeed. I see that Craig has posted in the chat area of GoToWebinar, also a link to get our free max price levels. Let me explain what are the price levels. Here you can see that on this pound Aussie pair we have several horizontal lines. These represent supply and demand level of the price. The color of each lines doesn't matter. It's simply for me a way to remember which time frame I have used to define them, because I use a multi-time frame approach to analyze the supply and demand levels. And so we have two formulas, one free subscription formula and one paying subscription formula. With the free subscription, it's completely free, and Craig has given the link. You receive every Sunday, I do that generally the Sunday. The Sunday you receive these price levels for 4 pairs, the Euro US dollar, the Euro Aussie, the Aussie yen, and the pound yen. The list has been defined 1 year ago based on how do we call that? We have asked our members what pairs they would like to receive for free. So they receive 4 free pairs, and it is available to non-maxers, so everyone can access these pairs. And the paying formula is way more extended, so I analyze these price levels for 15 to 19 pairs, plus indices like the S&P 500, the Dow Jones, the Nasdaq, the DAX, the German DAX, oil, crude oil, which one else? Gold, of course. And recently I have added on the request of several members the Bitcoin, even if I don't like cryptocurrencies. So this represents approximately 24 to 27, 28 instruments, so each week. What I produce is a template for each pair, and so when you receive that list, there is a template for each pair. You apply the template to a naked chart, and then we have a small script which is provided to a small script which allows to copy these levels on the chart you want to see them. The chart, for example, you trade. And so the paying formula is not expensive. I think it's around 50, something like that. I don't know exactly the price, around $59 per month for all the pairs. So. And they are good for any time frame, from the 5-minute time frame to the monthly time frame. Oh, we can see that here the pound Aussie has reversed its slow bias to the upside, but not yet in the time bar chart. And here I will not consider trading long until the two charts are in agreement. We can trade the CRB chart independently of the time bar chart, but the trades are riskier. I prefer, because I am a risk-averse trader, I prefer to wait the two charts are in agreement. This means that we have to wait for the slow bias to turn from red to green, and then most probably we will have to wait for a pullback in the CRB chart before having a long setup. The possibility is the price will come back with the long bias reversing from green to red. Of course, we always trade in agreement with the slow bias. Bye, Melvin. Nice to have seen you in this session today. Now, a nice feature we have with the Max Trade Manager is you see here that small button RP. RP means reset. It's a reset button, and if we don't use it, in fact, on the next trade we open with the MTM here, the size of the trade takes into account the initial balance at the start of the session. If I use the reset panel button, all the numbers will be set to 0, and the next balance which will be used is the new balance. In this case, with a profit added to the account. And so by resetting the panel, we activate the compounding process of the results. Let me show you the terminal panel. Terminal panel, just to give you an idea. So view terminal. See, the initial balance was 10,000 euro with 3/4% of a profit. This means indeed 77 euro in this case profit in the account, and you can see in the account history the two exits, the first MX, the XXX, and each unit had a size of 35 microlots. Okay, so the global trade when it has been opened was 7 mini-lots. So the MTM Max Trade Manager handled that for you easily. You have just to focus on pushing on the right button while you are in a trade. Okay, it seems that the trend has reversed to red. This candle was set up bar, but we are still in a concession zone mode, and we have to wait to decide. Yeah, we can adjust simply the support level, so and this level, and we have to wait for the moment for the price to break that level. The kind of agreement I want to see, Sinisa, is the two bias, slow bias be in agreement. So you have seen that for a moment the slow bias have turned from red to green in the CRB chart, but it was still red in the time bar chart. So in such case, I say the bias are not in agreement. Now it has turned again in red in the my chart is frozen. Ah, that's strange. So, no, the slow bias in the context of the CRB chart can reverse before the slow bias in the time bar chart, because the CRB chart sees more details in the price movement, and so sometimes they are not in agreement. Okay. Okay, this candle, if it closes as a breaking candle, would be, okay, this is a setup bar to go short, but again, the global context is not appropriate, and we are now late. We are left 15 seconds, but my entry, should I would taken that trade, my entry would be, I need to go fast, would be at this level 888, so right at this level. Okay, okay, the trade would have been open, so here the stop loss would be oh, in this area it's a good it's around 25 pips again. And then you would have had a third trade available. So yeah, sometimes GoToWebinar change its versions with a lot of improvement. And so in the time it was easy to change the presentation from one screen to another screen, because I have on this PC two screens, but I don't see that possibility again in this new version, but I can stop sharing my screen and then restart the sharing of the screen. This is the way I have unfrozen my chart. Okay. So have I answered your question, Sinisa? So no, they are not always in agreement. What may happen, you have seen that momentarily the slow bias in this CRB chart have turned to green, and then it has turned to red again, because the color is never fixed before 30 minutes. Because this slow bias is based on the 30-minute time frame. So as long as a 30-minute bar has not closed, the color can change. And the slow bias will reverse faster with a CRB chart than with a time bar chart. And you see, when we have a forced trade, what happens, this is a typical behavior when we have trade being forced, so not taken into agreement with the global context, as I have explained after the non-farm payroll. We are still in that context, and we are approaching so the moment when trading will become less interesting for the European session. So sooner or later you will have a losing trade, and this is typically what such a losing trade will do. Immediately after the entry, the price reverses against you, and this is when you are in the appropriate context, the situation when you have not to panic. Okay, a trader is never made good or bad with just one trade. If you take a trade, you have decided to take the trade, you have to handle the trade, whatever the result will be. Okay? No, they are not the same. Yeah, they both use the 30-minute time frame, but they are. It's still sensible to the chart it applies to. Okay. I have lot of examples I have observed. Now, the main thing we have to consider when you trade with the max is the following. As long as the movement you are trading makes sense for the trade, you have to sustain any pullback the price may have. You can, of course, as it was the case here, and using the rule, reduce your risk by making an MX in this case, knowing that this will help to reduce the loss should the trade be closed as a losing trade. But as long as the movement is not invalidated, or as long as the trend does not reverse, you have to stick to the trade. The invalidation would have happened here, as I have explained previously, should the price cross that level, close above and follow through, hitting the exit level we would have defined. It's very common for some traders to panic when the price begins to retrace after the trade has been opened. There is no reason to panic. The pullbacks are normal, and when we have no momentum, because we have almost no momentum here, but with a lot of volatility, it's normal that the price makes such retracement. Having no momentum in this case is the reason why I say the conditions were not appropriate to trade the non-farm payroll today. The conditions were not appropriate to create momentum, because we have not seen the two numbers in agreement. So, okay? No, Sinisa, I don't wait for other type of agreement. So during the last minutes we will be together, around maximum 10 minutes. Let's see what the price will do on this trade or on this movement, because I have not taken it, I have simply marked the chart. On the time bar chart, we can see most probably, let's check, yeah, the price is also entering, you can see, into a concession zone mode. So this is the reason why we had to wait for that breakout here. But anyway, a breakout is never a good breakout if the context is not the good context. The context is, for me, the most important aspect in trading. Many trading systems, good trading systems, are based on technicals only. And many traders have a tendency to focus only on that aspect because it is the easiest part in trading. The risk aspect is important too, fundamental, of course, and the global context, understanding the global context, is for me the most important aspect in trading, because this is the way to take only the trades which are worthwhile to be taken. It doesn't make sense to take a short trade if the global context tells you to take long trades, to privilege long trade, and vice versa. Or it doesn't make sense to take trades when the global context tells you it's not appropriate to take a trade. Whatever the movement you will see, it's not because you would see a large movement that this movement is created by the big boys. It is possible that big boys are absent, and these movements are simply created by smaller traders. Okay? You can see here now we have the movement being invalidated, and so the exit would be somewhere in this area, smaller than the stop loss, if the price follows through, but which is not the case. And we are again in this area approximately, with the price flirting with our TT line. Which is approximately on this level on the time bar chart, approximately on this level. It is not the support of this consolidation zone mode, it's something else. Using my discretionary decision, so this is a trade, should have I taken that trade, I would not have closed one unit yet. I would still be with my 2 units as open units. Vincent asked, do you have a volume approach when choosing an FX pair? No, Vincent. We can use the volume in Forex, provided you have a broker with a large base of customers. In such case, the tick volume provided by the broker, which comes from his activity, will be approximately well correlated to the volume, the real volume in the Forex. We don't know the real volume exactly, because the banks do not provide always their volume. There are services now given the volume, but I found that it's difficult to analyze the volume in the Forex. The volume analysis is a complex way to analyze the price movement, and so I prefer to focus on the momentum when we know that movement must be developed. Okay, yeah, you can use the CME FX volume, of course, but you need then to follow the currencies on the CME. You can trade, for example, you can analyze the currency futures contract too, in which case you have the true volume. Knowing that you will have a small difference in the price of the futures contract with the spot or the cash. The difference between the two takes into account the interest for the number of days until the expiration day, and at the expiration day the two instruments are identical, have the same price. But the analysis is valid at that moment. But anyway, for the moment, no, I don't take the volume into account. This is one subject I am interested, which is part of the project I have, because of course my preoccupation when I trade with the MAX, and this has happened 2 times since I'm using the MAX since 2008, how to improve the trading process with the MAX. The first improvements have been to introduce the ETF concept, so the SAM concept, sorry, and the second has been to introduce the ETF concept. And one of my projects, I have a lot of projects, is to take into account indeed some aspect of the volume, and especially the hidden volume. There are sometimes information available about hidden volumes, and the hidden volumes gives sometimes good information to validate the directional bias. So, but it's more complex in the context of the Forex than in other markets. And when I say hidden volume, so this concept has several names: hidden volume, iceberg, dark pools, and so on. Dark money. Even on a regulated market, for example, if you take the stock market or if you take the future market, you don't necessarily always see all the volumes on your time and sales window. Some volumes, if they respect some trades, if they respect CME's criteria, the volumes can be hidden and be shown later. The volume always appears at some moment, but it can be shown with some delay, an important delay, sometimes the next day, for example. But it's too late. For the retail trader, it's too late. But there are sometimes ways to catch these hidden volumes. Okay, I see no other question. Let me check in the question area in our either the private Max chat room, no, and in this GoToWebinar room. Let me check if I have answered all the questions. If I have not answered the question, you please, in the last 1 or 2 minutes we have, repost the questions and I will be glad to answer, of course. So I hope you have enjoyed this session. The aim of this session was to show either a nice movement with a surprise in the non-farm payroll, which has not happened, and the second aim was to show how our trade risk management helps to somewhat optimize the trade result using all the rules at our disposal. And I've tried to explain the 2 approaches we have, either strictly to the rules or, when possible and when feeling comfortable, using the discretionary situations when they occurs. And so this has been the illustration of my first trade, the first trade, and it has been also the opportunity to illustrate that when we have more challenging movement with our SAM concept, we can exploit these movements nicely, and we can have fine-tuned information when we use our Max Trade Manager tool, giving us essential information to know at every moment where we are in our trade. So I hope you have enjoyed this session. I thank you very much for your participation and see you in one of our next future sessions. Oh, I thank you very much for your comments. So the non-farm payroll is indeed one of the most difficult news to trade, and I like to make it a public session. So because when conditions are appropriate, there is always something to learn with the non-farm payroll, either about the news itself or with the Max. So I thank you very much for your participation, your question, your comment. I wish you a great weekend, and so see you next time, either in an open house session or in one of our Max courses or activity. Bye everyone, and in the meantime, take care.